$80 broke in a way markets were not prepared for. This was not a test, not a pause, and not a reaction to headlines. It was a clean failure of a level that had held for years. When that happens, it is not price that matters, but structure. Positions that depended on control were exposed. Systems built on assumptions were forced to adjust. And the most important question became simple: what just stopped working and who is now trapped? Welcome to Financial Explanations. This channel exists for viewers who value clear thinking over noise and analysis over excitement. If you have spent years learning that preparation matters more than prediction, consider subscribing. It is like keeping important documents ready before you need them. Also, share in the comments where you're watching from, because markets may be global, but decisions are always personal. The silver market reached a moment that was not supposed to exist. For many years, the area near $80 acted like a ceiling. Traders respected it, institutions planned around it. Risk systems were built with the expectation that this level would resist price movement. In past cycles, when silver approached this zone, selling pressure appeared and momentum slowed. The market behaved in a controlled and familiar way. This time, it did not. When silver moved through $80, it did so without hesitation. There was no long struggle and no extended consolidation. The price moved with speed. For experienced observers, this was the first warning sign. Markets do not break important levels quickly unless something underneath has changed. Commodities are normally slow to reprice. They are tied to production, transport, storage, and long-term contracts. Large moves usually develop over time. A sharp and sudden move suggests stress rather than enthusiasm. It suggests that supply and demand are no longer aligned at the expected price. In the days before the breakout, silver prices fell sharply. Many retail participants interpreted this as fear. Some believed demand was weakening. Others assumed the market was correcting naturally. Professional participants saw something different. They recognized a liquidity event. The price drop pushed silver into areas where many traders had placed stop-loss orders. These automatic sell orders are designed to limit losses. In modern markets, algorithms detect these clusters. When prices reach them, selling accelerates quickly. Weak positions are forced out in a short period of time. The move feels emotional, but it is largely mechanical. Once those positions were cleared, the selling pressure ended. In normal conditions, prices would stabilize slowly. Buyers would enter carefully and volume would return in stages. Instead, silver moved upward immediately. The speed of the reversal indicated that large buyers were already waiting. They were not reacting. They were prepared. This reveals an important truth. Demand was not created by the drop. It was already there. Industrial users, long-term funds, and large allocators had orders ready. They were waiting for liquidity, not chasing price. When selling stopped, they entered at once. Supply disappeared faster than expected, and the market had to move higher to find new sellers. This is known as a failed bear trap. A bear trap occurs when prices are pushed lower to convince participants that further downside is coming. Those who sell or short the market expect continued weakness. When prices reverse instead, those positions become liabilities. The faster the reversal, the more damaging the trap becomes. Breaking $80 turned this into a structural issue. This level was embedded in institutional systems. Exposure limits, hedging strategies, and margin models were built with the assumption that silver would remain below it. When the level failed, those systems adjusted automatically. The price itself was not the problem. The assumptions behind it were. Markets communicate through behavior. A slow rise suggests optimism. A violent break suggests imbalance. In this case, the imbalance was between paper exposure and real demand. There were more promises to sell silver than sellers willing to provide it at those prices. This does not mean physical silver disappeared overnight. It means that at the margin, supply was not available at the expected price. Buyers were forced to pay more quickly. In a leveraged market, this affects spreads. Short sellers began to lose money. Losses are manageable when they are small and gradual. They become dangerous when prices move fast. At certain points, positions must be closed by rule, not by choice. Closing a short position requires buying. That buying pushed prices higher, which increased pressure on remaining short positions. This created a chain reaction. The price did not rise because of belief or excitement. It rose because positions were being unwound. The key insight is that the breakout revealed fragility. A stable system absorbs stress. This one did not. It adjusted violently, suggesting that control had been tight and buffers were thin. This move was not driven by retail enthusiasm. Volume and timing indicated institutional activity. It occurred when liquidity was limited, a moment when structural changes often become visible. Calling this volatility misses the point. Volatility is movement around stability. This was stability itself changing. The question is not how high silver may go next. The real question is what other assumptions, quietly built into financial systems, may now face the same test. What happened next cannot be understood by looking at silver as a metal. It must be understood as a system. For decades, the silver market operated on an assumption that supply was always available. If someone wanted to buy, someone else could sell. If prices rose too quickly, selling would appear. This belief shaped risk models, contracts, and trading behavior. It became a rule that few questioned. But that rule depended on something fragile. It depended on paper. Most silver trading does not involve physical metal. It involves contracts, promises, and obligations settled in cash. These contracts are efficient. They allow large volumes to move quickly, but they also create an illusion. They make supply appear endless, even when physical availability is limited. This illusion works only as long as confidence remains intact. At the center of this structure is short selling. In simple terms, a short seller borrows exposure to silver, sells it at today's price, and hopes to buy it back later at a lower price. The difference becomes profit. This strategy is common and often legitimate. It provides liquidity and helps smooth price discovery. The problem begins when short exposure grows too large. In the silver market, short positions accumulated over time. Many were not backed by physical metal. They were backed by margin, leverage, and the belief that prices would remain controlled. As long as silver stayed within a familiar range, this exposure appeared manageable. But leverage is calm only until it is tested. When prices move slowly, risk models adjust gradually. Losses can be absorbed, positions can be rolled forward. But when prices move fast, the system demands action. Margin calls are triggered. Capital must be added, or positions must be closed. Closing a short position requires buying silver exposure. This is where the illusion breaks. If many short sellers attempt to buy at the same time, the market must find sellers. But sellers are not guaranteed. They appear only if the price is attractive enough. When price rises quickly, potential sellers step back. They wait. They reassess. Liquidity dries up. This creates a dangerous imbalance. The market shifts from being supply-driven to demand-driven. In this phase, price is no longer set by valuation models. It is set by urgency. Those who must buy will pay what is necessary. Those who can wait will do so. This is not speculation. It is mechanics. What made this episode unique was not the presence of short positions, but their concentration and structure. Many were held by large institutions that rely on stability. These institutions do not expect sudden disorder. Their strategies assume time. Time was removed. When silver pushed through key levels, automated systems reacted. Risk thresholds were crossed. Exposure limits were breached. What had been a theoretical risk became a real one. Decisions were no longer optional. The market did not ask whether buying was wise. It required it. This is why the idea of naked shorts matters. A naked short is exposure without direct ownership or immediate access to the underlying asset. It relies entirely on the ability to source supply later. In calm markets, this works. In stressed markets, it becomes a liability. As prices rose, the cost of maintaining these positions increased. Margin requirements expanded. Losses multiplied. Institutions faced a choice: commit more capital or exit. Exiting meant buying into a rising market. Each exit pushed prices higher. Each price increase made remaining positions more dangerous. The system fed on itself. This is not panic in the emotional sense. It is pressure in the structural sense. From the outside, it looked sudden. From the inside, it was overdue. The deeper issue is that the market had been optimized for efficiency, not resilience. Efficiency removes buffers. It reduces redundancy. It assumes continuity. When continuity breaks, there's nothing to absorb shock. Silver exposed this weakness because it sits between two worlds. It is both an industrial input and a monetary signal. It cannot be replaced easily in manufacturing. It cannot be created by policy. When demand appears, it is real. When supply tightens, it cannot be solved with promises. Paper structures can multiply claims. They cannot multiply atoms. This is why rising prices were not the cause of the problem. They were the consequence. The real issue was the imbalance between obligations and availability. The price move simply revealed it. For business leaders and investors, this matters beyond silver. Many modern markets rely on similar structures. They function smoothly in normal times. They appear stable. But stability built on leverage is conditional. When one condition fails, the adjustment is not gradual. It is immediate. The silver market did not break because participants were reckless. It broke because the system was designed to hide stress until it could no longer do so. What followed was not a surprise to those watching closely. It was a reminder. Supply that exists only on paper is not supply. And when that truth becomes visible, markets do not negotiate. They reprice. That repricing has consequences that extend far beyond a single metal. For most of the modern financial era, authority has spoken softly and markets have listened. When uncertainty appeared, central banks adjusted rates, expanded liquidity, or offered guidance. These actions were not only technical, they were signals. They told markets that stability was being managed, that disorder would be contained, and that time would be provided for adjustment. The silver breakout challenged that relationship. Precious metals occupy a quiet but important role in the financial system. They are not productive assets like businesses. They do not generate cash flows. Their value comes from trust, or the lack of it. When confidence in policy is strong, metals remain subdued. When confidence weakens, metals begin to speak. Silver is especially sensitive because it sits between use and belief. It is consumed by industry, but also held as a store of value. This dual role makes it responsive to real demand and monetary stress at the same time. When silver moves sharply, it often reflects pressure that cannot be resolved through communication alone. This is where the Federal Reserve's challenge begins. The Federal Reserve manages expectations. Its power depends on credibility. When markets believe policy tools are sufficient, prices remain orderly. But credibility is not infinite. It erodes when actions are constrained. At the moment, silver broke through critical levels. The Federal Reserve faced limits on all sides. Raising interest rates aggressively risked damaging debt-heavy sectors of the economy. Government borrowing costs were already elevated. Corporate refinancing depended on stability. Higher rates would have tightened conditions too quickly. Lowering rates was not an option either. Inflation pressures had not fully disappeared. Cutting rates would signal weakness and risk further loss of confidence in currency value. Liquidity expansion carried its own risk. Injecting more money into the system could calm markets temporarily, but it would also reinforce the perception that real value was being diluted. In such an environment, precious metals do not retreat. They strengthen. This left the Federal Reserve with fewer effective responses than it appeared to have. Importantly, this constraint was visible to institutional participants. Large funds do not react to speeches. They react to balance sheets and incentives. When they see policy boundaries tightening, they adjust positioning quietly. Silver's move reflected this adjustment. There was no official announcement, no emergency meeting, no public alarm. That silence was itself a signal. It suggested that intervention was either unnecessary or undesirable. Markets understood the difference. When authority chooses not to respond, it is often because response would make the situation worse. This creates a subtle shift. Markets begin to price reality rather than reassurance. They stop waiting for guidance and start protecting exposure. This process is gradual in large markets, but it can appear suddenly in smaller, more sensitive ones. Silver was such a market. As prices rose, it became clear that the move was not being resisted. There were no visible efforts to suppress it, no coordinated messaging to cool expectations. For those watching closely, this absence mattered. It suggested that silver was no longer the priority. Central banks focus on stability in major funding markets, government bonds, and currencies. When stress appears elsewhere, it is often tolerated as long as contagion is limited. Silver's breakout may have fallen into this category, but tolerating a signal does not eliminate its meaning. For business leaders and investors, the lesson is not about predicting policy actions. It is about understanding policy capacity. When institutions reach their limits, markets do not stop. They reroute. Silver's rise indicated that confidence was being reallocated, not destroyed. Capital was moving toward assets perceived as less dependent on policy decisions. This does not imply imminent crisis. It implies transition. Transitions are dangerous, not because they are chaotic, but because they are misunderstood. Many assume authority remains absolute until it fails visibly. In reality, authority weakens quietly, through inaction and constraint. The Federal Reserve did not lose control in a dramatic way. It faced a situation where control was less effective. That distinction matters. Silver acted as an early indicator, not a headline event. It moved first because it is small enough to move and honest enough to reflect stress. Larger markets often follow later. This is why dismissing the move as a niche event misses the broader context. Precious metals respond to shifts in trust long before equities or credit markets adjust. They do not require consensus. They move on marginal decisions. Those decisions were changing. The Federal Reserve's dilemma was not about silver prices. It was about the message that silver prices were sending. Responding forcefully could have amplified that message. Ignoring it allowed the system to absorb it quietly, for now. For those allocating capital or building businesses, this moment offered a reminder. Stability is not a permanent condition. It is an outcome that depends on tools, timing, and belief. When belief adjusts, markets move ahead of policy. Silver did not ask for permission. It simply revealed the boundaries of authority and moved beyond them. The silver breakout was never meant to be a call to action in one market. It was a test, not a test of optimism or fear, but a test of structure. It revealed how quickly prices can change when assumptions fail. For business leaders and capital allocators, the value of this moment lies not in prediction, but in preparation. Most businesses do not hold silver. Most entrepreneurs do not trade commodities. Yet the mechanics that appeared in this market apply far beyond metals. They reflect how modern systems behave under pressure. The first lesson is about speed. Repricing now happens faster than decision-making. In the past, shifts in value occurred over quarters or years. Contracts could be renegotiated. Strategies could be adjusted gradually. Today, leverage and automation compress time. When thresholds are crossed, adjustments are immediate. This creates a risk gap. Those who depend on stability may discover that stability was conditional. Those who plan only for average outcomes may find themselves exposed to extreme ones. The silver move demonstrated how quickly the margin for error disappears. The second lesson is about visibility. Stress rarely appears where attention is focused. It appears in secondary markets, specialized inputs, or overlooked sectors. Silver was not the center of global finance, yet it reflected imbalance before larger markets reacted. This pattern repeats often. Energy markets, shipping rates, and niche credit segments frequently signal change before mainstream assets move. Leaders who monitor only headline indices often react late. Those who watch inputs and constraints react earlier. The third lesson concerns balance sheets. In environments shaped by leverage, cash flow matters more than valuation. When prices move abruptly, access to liquidity becomes decisive. Businesses with flexible financing can adapt. Those with rigid obligations struggle. This does not require pessimism, it requires realism. Preparing for volatility does not mean expecting collapse. It means building capacity to endure adjustment. That capacity comes from conservative leverage, diversified funding, and an understanding of dependency risks. The silver event also highlighted the difference between nominal value and functional value. An asset may hold its price on paper, yet lose usefulness if counterparties fail or contracts cannot be honored smoothly. Businesses that rely on long chains of obligation are especially vulnerable to this disconnect. Resilience comes from simplicity. Clear ownership, transparent contracts, and manageable exposure reduce reliance on external stability. In a system where repricing can occur without warning, complexity becomes a liability. Another important insight is about narrative. When markets reprice, explanations arrive later. Media coverage often focuses on surface causes. Leaders who wait for consensus act after the fact. Strategic advantage belongs to those who recognize signals before they are explained. Silver's movement did not require interpretation to matter. It required observation. For young entrepreneurs, this moment offers a quiet but important lesson. Growth strategies built on cheap capital and predictable conditions must be reevaluated. This does not mean abandoning ambition. It means aligning ambition with durability. Markets are not becoming more hostile. They are becoming more honest. They reflect constraints faster and with less tolerance for imbalance. Businesses that understand this adjust expectations early. They invest in adaptability rather than optimization. For experienced business leaders, the takeaway is about stewardship. Capital must be allocated with an understanding of systemic exposure. This includes supply dependencies, funding concentration, and policy sensitivity. Stress testing assumptions is no longer an academic exercise. It is a strategic requirement. The silver breakout showed how quickly conditions can change when one layer of confidence shifts. It also showed that change does not announce itself loudly. It begins quietly in places few are watching. Preparing for such change does not require radical action. It requires awareness, monitoring signals beyond one's immediate industry, maintaining financial flexibility, avoiding over-reliance on a single scenario. These principles are not new. What has changed is their urgency. In a world where markets reprice first and explain later, leadership is defined by readiness. The ability to remain operational, solvent, and decisive during adjustment separates those who endure from those who react. Silver was not the message. It was the messenger. And the message was simple. Systems do not fail all at once. They reveal themselves. One break, one signal, one repricing at a time. Those who listen early gain time. Those who dismiss early signals surrender it. In environments shaped by leverage, speed, and constraint, time is the most valuable asset of all.